Welcome to Investing in Startups. I'm Joe Magyer. Our host this week is my friend Owen Raszkiewicz, founder and CIO of Rask Group. Owen recently had me on his show, the Australian Investors Podcast. I thought listeners here would enjoy the conversation. I talked about making the move from public to private markets, how small firms can compete with big firms, the current venture landscape, putting AI to work as an investor, and unit economics. It was a fun, nerdy conversation. Thanks. Please enjoy.
Joe Magyer, how you going?
I'm great, Owen. It's good to see you as always.
Good to see you, mate. I know it's a lot hotter where you are, a lot balmier. Here in Melbourne, Australia, it's quite chilly, but today we're going to talk about some really interesting things. And I think for most people that are interested in smaller companies, private companies, unit economics, portfolio construction, this is going to be an awesome chat. So super grateful that you can be here today and also take some time away from Seaplane Ventures, which I know is your baby right now and she's cooking. So why don't we start there, mate? For folks who maybe haven't come across you or don't know about your track record, can you just give us maybe a little bit of the backstory of like, what's Seaplane and why did you decide to launch it?
Sure. So Seaplane is an early stage venture capital firm based in Austin, Texas. I'm a solo GP, which means I just work by myself. It's a boutique. I'm happy to keep it that way. I used to run Lake House Capital, which I'm guessing some of you are familiar with. You might know Donnie, who has been on the show. Great guys. I co-founded that with Donnie, ran it for years. Loved it. Great experience. But I learned that I don't enjoy running a big firm, and I wanted to move back to the side of the planet where the rest of my family was. So I solved for both of those things by moving to Texas and starting Seaplane. Our sweet spot at Seaplane is startups that have live products, early traction, early enough you wouldn't have heard of them. It's still very early days, and they're looking for capital and a long-term partner to help them go faster. So in a nutshell, that's what we're doing at Seaplane.
I love it, mate. And how long have you been going? How long has Seaplane been up and running?
It'll be 3 years in a month.
Wow. You were just talking to me off air about some of the things that has happened since then, and it's obviously super impressive, which we can dive into throughout the conversation. One of the questions that I had for you early on was like, so very different markets. Can you describe that early piece of like going from public markets and having an exceptionally good track record there, and then how you thought about applying that craft and why it was so important to you to apply that craft in venture on the private side?
Yeah, I moved over to private markets and early stage in particular for 3 reasons. The first is that it's more fun. It's hands-on. You can affect change more. And when you're involved in an early stage, you can better shape the trajectory of where things are going. To be very clear, it's the founders who are, the captain, first mate, and all the core crew. Like I'm in the kitchen scrubbing dishes, but I scrub where I can help and I'll mop the floors if they need. It's more fun and engaging in that sense.
Yeah.
There's also more upside. So the rewards when you're right are much, much bigger. A good way to frame that might be if you're in public markets, you might underwrite towards trying to double your money in a stock over 5 years, which roughly shakes out like a 15% annualized return. And if you can do that across a portfolio, you're doing pretty well. You're probably happy with that. And if you roll that forward, you're talking roughly a quadruple in a decade. In venture, you would underwrite more towards something like a 20x over a decade, including dilution. That doesn't mean that you're going to get it, but the bar is much, much higher for what investors are going after. And the magnitude for when you're right is it's very large. I'll give you an example, but Figma, which I'd imagine a lot of folks know, but recently went public at $19 billion valuation. That seed round was done at $16 million. So if you were in on that from the seed and not accounting for dilution, which was real and happened, but you're talking about a 1200x return. So the payoff there for being right is just huge. And, you could say that's totally cherry picked, but, we've had an early win in our portfolio, which we haven't cashed out, but is pretty substantial. And I would say larger than anything I had in public markets within the 2-3 year time horizon that we've been involved. And it just speaks to the potential for getting outsized returns when you're right. The other big piece is companies are just staying private for much longer. So Amazon IPO'd back in the late 90s at a $400 million valuation. Again, Figma didn't list till they were at 19 billion. OpenAI reportedly, is valued at around 500 billion today. And when you look at that, just from a public perspective, it feels like it's a lot harder to get juice out of the lemon with high growth companies early. And like, you can do well owning mid large cap stocks, like I did, but the reward for being right, again, is just so much larger when you're early. And when you kind of put all that together, it's more fun. There's more upside. And I think the puck is going towards companies staying private for longer. So it makes sense to put more of my capital and time into trying to be early.
That's really well said. Like, your intellectual capital is like, if you're really good at this game called investing, apply it where you get the most leverage, right?
I think that's exactly it. And that's why like the spot I'm focused on at Seed is, it's not pre-seed, pre-product. So I don't think I have the superpower of being able to look a founder in the eye, being like, this is the next Elon. Like, I don't have that. But I think I can start to look at companies' early traction results, think about the market, the founder in that context, and have a little bit of raw material to work with. And that's where I want to take my edge too, just to that space where you get the biggest asymmetry.
When you're setting up Seaplane, what did that look like? Like, you've got to get investors, you've got to find companies, you've got to establish a network. What does it actually look like?
It's interesting because it's my second firm that I've started, but the first one in venture and the first one in America. Fortunately, having gone through standing up Lakehouse, which was, I would say, much harder in terms of complexity than a private market fund, because in public markets, well, the two major differences are, Lakehouse focused on retail investors and public securities. So the custody piece, the admin piece are far more complicated, whereas our firm at Seaplane just takes accredited investors, which makes things much lighter. And there are continually changing prices of the assets that we're invested in. The big difference, obviously, is we're focused on startups. The good news is there is so much infrastructure today to get a venture fund stood up that the actual admin piece is fairly abstracted away from partners like AngelList, who I use, who allow me to really focus my time on supporting our founders, finding great investments, and working with my LPs as well. And there's this juggling act when you're getting going, just like any investment firm you're getting started, where you're trying to find investors who are bought into your vision and what you're trying to deliver on, but at the same time, trying to find great investments as well. And there's a bit of a chicken or the egg where it's like, how can I find investors if I haven't proven with the strategy, but how can I do the opposite? And it's like, well, you just have to do both at the same time. And just like I tell founders sometimes who come to me and they're like, well, how can I get traction if I haven't raised a lot of capital? I'm like, well, people manage to do it. And just like I need to do it, founders need to scramble as well, because I'm a founder myself doing what I'm doing with Seaplane. But fortunately, like I said, there are a lot of great partners and tools out there. And we could speak to the AI piece later, but that has certainly made, like, building my own custom AI tools has made investment research run much faster as well, which has been great.
That's cool. Is being in Austin an advantage for you? Because I hear more and more, about Austin becoming this hub. How do you think about that?
Yeah, it's a top 5 venture city in the US. So there's gravity to the city. There's a great network here, a lot of good relationships. And it was recently voted the best place to start a company in America. It's the fastest growing major city in the US. So there's a lot of momentum here. That said, we do invest all over the US. We've got companies in Kentucky, South Carolina, Utah, not places you would necessarily jump to thinking of as startup hubs, and Austin. But then we've also got San Francisco, New York, which you would. And they're places where there's a lot of talent. And we're just going to go where great startups are. And wherever that is in the US, we're equal opportunity.
Do you define those companies? Do you jump on a plane? Do you go to those conferences? Do you attend, pitch nights? Like, what does that look like for you?
Yeah, I do get on a fair number of planes. I'm racking up some miles, but it's fun and I enjoy it. And it's just a great excuse to meet really smart, interesting people building compelling companies that are changing how we live, work, play. And I get to meet a lot of other interesting investors and just nerd out and have really nerdy conversations with them. So that's a lot of fun. A lot of it's over Zoom. I think pre-COVID, there was a general vibe that meetings between investors and founders needed to be in person. And that just completely went away. And that's, speaking to an Australian, I think in particular, people in Australia were earlier to adopt a lot of these video tools. And just speaking from experience, because we were so far away, and you're just so spread out. It was just very logical. And once everybody else in the world started shifting towards using Zoom, it was like, welcome, welcome to the club. This is totally fine. And so if anything, most of my founders, I don't meet in person before we invest. We'll have, calls over Zoom and that kind of thing, but we'll usually meet up after the fact. And it may sound like, well, why don't you try and meet these people in person? Well, I'll meet with over 40 companies for every one deal we'll do. So it doesn't really scale for me to, hop on a plane at that kind of volume. But I do try and spend time in person with founders where we do invest. And that itself has led to some other great investments on the back of those trips.
I want to talk more about your process in a minute, but one thing that I just want to kind of get to the meat of is people would have heard you on the show before or listened to your podcast, Investing in Startups, and know that you talk a lot about unit economics and understanding unit economics. And you talk about not being able to necessarily eyeball someone and predict what they're going to do over the next 5 or 10 years. But when a business is so early stage, what are those unit economics you're looking for? Or are they not necessarily in the data yet, but you understand the business model enough to infer what they might become, if you get what I'm saying? Like, what does that actually look like?
Yeah, that's exactly it. And to go back, at Seaplane, we're focused on companies with business models geared around subscription models or network effects. And anybody who's familiar with some of my work knows I talk a lot about those things and have for a long time. So I love those business models because they create a ridiculous amount of value when done really well. And if you look at the largest IPOs of all time, across tech or not, overwhelmingly, they're dominated by companies that either have subscription models or some form of network effect. Doesn't have to be a marketplace, but it could be. And just to bring it down to make sure I'm not losing anybody, if we're talking about network effects, that's a situation where each additional node or contributor to a network adds value for everyone else. So with Facebook, every time someone joins Facebook, it makes it more valuable for everyone else. Or you take the ASX, why do the buyers go to the ASX? Because that's where the sellers are, and vice versa. And whenever there's a new IPO, it just brings more gravity to the exchange. So there are plenty of examples of that. I'm very fond of those business models. They really are associated with long-term compounding. And I'm always on the lookout for companies that have that kind of model and early traction that suggests they might be able to scale into something big. The initial unit economics of these companies are pretty wiggly. They move around a lot. And I know that they may look amazing right out of the gate, but they're probably going to mean revert over time. And then on the flip side, though, sometimes I'll see them and say, look, I know this margin's low, but I also know that if this network effect unfolds like I think it might, that pricing power would really, really move higher here. And they'd be able to cross and upsell too. So these margins are understated. And it takes that extra layer of experience. And I think this is where the public market background is helpful, because I've seen how so many of these movies end that I can back solve into that. I should probably get into a little more to the heart of your question of what about unit economics is interesting to me. So
yeah, go for it.
When you're looking at companies and it's really early, you can't look at a P&L and assess the fundamental quality of the business. You can have a startup that's burning a lot of cash, and that may look terrible, but they're actually generating a lot of value, which is counterintuitive. And to go back in time on the ASX, Xero was the poster child for this, where they had massive burn, but they were acquiring new customers, generating some network effects in the process. And I'm rusty on the numbers, but from memory, I want to say for every dollar Xero spent acquiring customers, we thought they were generating something like $5 in long-term value. So because they had these very loyal subscribers. So you have this funny dynamic where losses are going up while value is going up as well. That eventually balances out, as you've seen with Xero. But that dynamic's true really across all subscription models. So I spent a lot of time trying to wrap my head around what those initial unit economics are today and where they could be and where they could trend to. And you have to be careful. These businesses, sometimes they're creating new variants of these business models, right? And it's not exactly like you've seen before. And if anything, you have to be careful to not over pattern match. So you have to have some fluidity, but at the same time, that pattern recognition is still really helpful. On the network effect piece, that one is different, where you could be looking for something like, what is the level of virality with this model? Now, virality and network effects aren't necessarily the same thing. You could have a product that has intense virality. It's not a network effect. Hotmail would be a good example. I'm going to date myself a little bit here, but when Microsoft first came out with Hotmail, they added a tagline at the bottom that was something to the effect of like sent by Hotmail. And every time someone sent an email, new people saw it and they're like, maybe I should get that too. That's viral, but it's not really a network effect because like if you use Hotmail, it doesn't change the value of whether or not I use Hotmail. So if we both use email, generally that's true, but that's viral, but not a network effect. But if you have a business that I look at and say, okay, this is an inherently viral model that I think can actually be self-sustaining even without additional capital, but we're going to pour some additional capital on here, like as gasoline for the fire. It's inherently viral, and the new customers it wins increase the value for everyone involved. Maybe it's, different suppliers, buyers, obviously the company who's making the marketer creating all this value. And if those things are true, that's really compelling. Obviously, the faster it's growing with the least amount of capital to do that, the better. Capital efficiency, I think that always matters. But when you're looking at startups, it matters a lot more because you don't have these companies are burning cash. They're usually coming back to raise money again every 2 years. That's just the typical cycle. So you need to be really thoughtful about, okay, there are really good unit economics, but does this line up with capital efficiency in a way that makes sense? Like I've seen, for example, some enterprise SaaS companies that have really long sales motions that in isolation might have good unit economics, but from a cash burn standpoint, it's like they're going to have to raise so much money in order to make this work, and there's going to be so much dilution. Anyway, long answer. That's how I kind of get into the weeds of unit economics.
That definitely answered my question, Joe, and a little bit more. So thanks for sharing that. So since starting Seaplane, let's just take a look at the big picture, Joe. So there's been a lot of change in venture. There's been a lot of economic and political change. There's also been a collapse of Silicon Valley Bank, and a lot of things have been shook up. I'm just curious how you think about like the macro environment, like say last 12 months, last 3 years, and where we are today.
Yeah, I think you can look at the numbers and tell whatever story you want to tell. My view of things is the market is warmer than it was 12 and 24 months ago, but still a lot colder than it was at the peak. And let's say 2021 into 2022. That 2021 era, valuations were running hot. There were companies that didn't have profitable or even hopefully profitable unit economics getting funded as late as Series B, which if you look at different stages through a venture cycle, Series B, that shouldn't be a question of whether or not the business model works. That should just be a question of how big is the market and what is the right price to pay for the business. At Series B, you have proven this is working, typically. But in 2021, there was money spraying everywhere. That is not the case now. Now, what happened, you had a big washing out in the industry. There was a huge reset on the amount of capital going into venture. And particularly for emerging managers, it was just very hard for firms to get off the ground. I wouldn't have been able to get Seaplane off the ground if not for my background at Lakehouse. And for those of us who were able to get live, I think it's been an awesome time to deploy. There's just been a lot less competition, but there's still the same number of great founders building exciting companies. So for me, it's been an exciting couple of years to be putting money to work. The market is warming back up. That is led by AI. And AI made up 49% of venture funding in the first half of this year globally.
Right.
I say AI, AI companies, that's very top heavy with companies like Anthropic or OpenAI just gobbling up vast amounts of money. But it has really spurred a sea change in interest in the industry. And it's funny, if AI hadn't come along when it did, there still might have been a bleeding out for a couple of years of venture. But in a way, it's kind of reminds me of towards the end of Logan, where Wolverine just like injects himself with that super serum and just goes full beast mode one more time. And you're like, you can't keep that guy down. That's kind of like venture with AI. You're like, oh, I think he's finished. Oh no, he can't be killed. So it's back. And there's lots of enthusiasm in the space. Obviously, it's hottest around AI, and we could get more into that. But I'm still really optimistic about putting money to work today.
Well, let's get into that, because I feel like what we're seeing in public markets is a lot of the SaaS companies, these technology first kind of companies, are really leading the charge in the adoption of AI. Now we hear things like vibe coding and all these different crazy tools that are coming to market and the kind of use cases around that. How are you seeing it? Like boots on the ground, talking to these really innovative founders. I guess it's just a broad question. Like, how are you seeing it? How does it impact you? You mentioned AI agents before. Let's just jump off wherever you'd like.
Sure. I think investing in AI is a lot more nuanced than you might get the impression sometimes. So you have some investors who are all in on AI and almost regardless of price, or not just almost, regardless of price. They're like, look, we want to invest in the best AI companies possible, or just the best AI deals we could get in, or just whatever AI deals we could get in. And then there are different tiers of thoroughness that go with that. On the flip side, you've got some investors who are just kind of in the hater camp where they're like, oh, this is so hot. It's a fad. Everything's overvalued. I think two things can be true at once. AI is hugely disruptive and is a generational sea change in technology. And I think that's true. But also, there are plenty of companies that are overhyped or overvalued. And there's going to be a lot of garbage that goes out with that. And both those things can be true, but there can still be great companies being built that are working their way past that. I think obviously if you look at the biggest companies in the space, again, Anthropic, OpenAI, the thing with those is those are companies that were backed by people before ChatGPT exploded on the scene 3 years ago, right? And these people were ahead of the curve. And so now a lot of people coming into AI, I still think it's an attractive space to be, but I think you have to be a lot more selective about where you're looking. And I think you need to be careful that you're not looking at companies that are trying to do something that someone's already trying to solve for. For example, I can't tell you how many legal tech AI companies I've seen that are all trying to do roughly the same thing. And AI definitely can help law firms be more efficient, and they can help clients. And there's lots of room for improvement, but you need to be careful that you're not getting into red water and just super competitive spaces. I mean, for me, I've done some AI-centric deals, but at this point, frankly, almost every deal that crosses my desk has some kind of AI component to it. Sometimes that's founders just trying to shove AI into their product. But, the more interesting ones are where it's native to what's actually being built.
So is it a case of, like, you have these beautiful SaaS businesses with compelling unit economics? Is a lot of the time what you're seeing is those types of companies are enabled by AI rather than building their own engines and those types of things? Like, I don't want it to be like your app is my feature kind of thing, that old cliche of you have this fantastic product, then you'd put AI with it, but then ultimately some other big AI juggernaut like Anthropic just offers something that's similar to what your business is doing. You know what I mean?
Yeah, I do. And this is one of those rare instances where the incumbents may have advantages over the challengers just because they can roll a lot of these features in pretty easily. Google, for example, seemed to be way behind when ChatGPT snuck up on them as a product from OpenAI. And, I still think that Google as a product might be challenged, right? In the same way that I now use ChatGPT or Grok multiple times a day for things that I would have used Google for. I'll still use Google for very direct, simple tasks, but the more intricate, thoughtful ones I use AI for. But Google not only built a lot of their own tools, they've incorporated ones from others. And I think there's just going to be a lot of value captured from these incumbents where if you take Salesforce, you got a business where you have logo level retention rates in the high 80s. Customers aren't going to leave you because you lack a certain piece of AI. Like the biggest reason Salesforce customers probably leave is because they folded or got acquired. You just generally don't leave. So if they're able to offer an ancillary product that some challenger is spinning up and it's like, hey, we can add this and it's either a free feature or we're going to make it pretty reasonably priced and attach it and there's seamless integration, that's compelling. I think a good example of that, it's not AI centric, but where you've seen it was Zoom. Zoom itself kind of became a verb. Zoom was exploding, like from a venture standpoint, was doing incredibly well. Where that was a business, to get back to virality, had network effects and virality. It was beautiful, incredibly cash efficient, capital efficient. And then what happened? The market became so attractive that Microsoft pushed Teams hard, Google pushed Meet hard. And before you know it, Zoom it's still a viable business, but it went from this disruptive challenger to now being outside looking in. because the incumbents have this distribution advantage. So I think you'll see different versions of that in different industries. In some cases, AI is just such a perfect fit for upending what's there. I think that'll happen. And a lot of incumbents just aren't positioned to build those kind of tools internally. But in others, you'll see cases where incumbents are a lot harder to kill than people think.
So one of the things, Joe, is when I listen to your podcast or so many others, you hear of these massive household names in venture, like names that for any investors, it just springs to mind.
Sequoia, Kleiner,
yeah.
A16Z.
Yes, you brought up A16 before. So those names, they're huge. They've got people everywhere, teams across not just America, but across the world in many instances. How do you compete with that?
Yeah, it's a great question that I think founders of firms should be really intellectually honest about. What can I do better than they can? And how can I be different? I'm not trying to out Sequoia. And I know some small funds that try and do that. I think that's pretty hard. I'm not trying to do platform investing better than they can. I can't add more resources and value. For example, Sequoia 16Z, they have recruiting teams that help founders recruit for talent. Like, there's just a level of resource there that is so immense in Fallen Capital that I can't compete with. But there are advantages that I can lean into that they can't match. So one is, if I'm talking to a founder, I make it a point to say, well, you're talking to the investing committee. This is the partner meeting. You're not talking to an associate who wants to talk to you every 3 months to keep an eye on you just so that they can make sure they told their boss that they'd talk to you. And maybe they pass you up to a principal who passes you to a partner. And then maybe you make it to a partner meeting. Like, you're talking to the decision maker. Another thing is, you don't have to worry about firm turnover, because that's, we got pretty strong alignment on that front at Seaplane. There's no secret, but there's been a lot of turnover in venture after the bottom fell out in the market. You have situations where a venture firm might have done your round, and then the guy who did the round left. Maybe he went to start his own firm. Maybe he left the business entirely. Well, that's a pretty uncomfortable place to be in as a founder, and something that founders appreciate is just the alignment around, like, I know Joe's not going anywhere. He is the firm. The other piece is we're concentrated, and a lot of these big firms, they have hundreds and hundreds of investments in the portfolio. It's no secret that if you're not one of their better performers, the phone may not get answered when you call. But when you run a concentrated portfolio, what the founders really like about that is they know that you're not just buying a lottery ticket with them. This isn't just a flyer. It's like a meaningful investment in your fund. And when you're a solo GP, that's all the more meaningful. And they know that I have real skin in the game on multiple levels of trying to help them succeed, because their success is our success. So it's shared. And I think they really value that, and that stands out. I think that helps with allocations. Then the last bit is flexibility, agility, just trying to work with founders on their terms. And I just think each of those things, it adds up. It's really important to try to be differentiated, and it's hard to do that. But I think if you find your spots and stick with them, there's room to add value, so long as you combine that with you're hustling to source good deals, you're picking well, and you're constructing a portfolio in a thoughtful way.
So you've got that nimbleness, but you've also got that focus and the respect for the founders, because they know that you're the guy, and you know that you are investing directly with them and it's meaningful to you. So there's kind of that connection that comes after the fact as well, which is super powerful. Maybe a good way to illustrate the way you think about the search process and then the research process of what you do at Seaplane is to use maybe either some examples or just describe the process that you go through from the how does a founder reach you to the point of writing a check.
Sure. I'll maybe use a couple of different, like very different examples just to give you the full range of how these things can play out. So the way most founders reach me, it's either direct or through referral. And founders who want to get in touch, you visit seaplaneventures.com, and there's a form there. You get in touch. I read everything that comes through. There's no bot or no AI yet that reviews that on my behalf. That's still me doing it. And I try to get back to everybody that gets in touch, at least the ones where it's actually tangentially tied to our thesis. I try to qualify that. I get a lot of cold emails inbound. I ask people to come through the site. It's just easier to structure. But intros from other investors are the other major source. The actual working through a potential investment can go a couple different ways. And, high level, when you're a small firm like Seaplane is, one of the ways you need to compete is on flexibility and speed. Now, that's not to say that I want to rush a process, but it does mean that I need to have a process that can move quickly when there's something that I'm excited about and I can be opportunistic. So I'll give you a couple of really different examples, but still kind of speak to that. One is a company, I won't name names, but they had really attractive traction, founder with amazing founder market fit, serious hustler, total straight shooter, love the guy's personality, second time founder, first startup didn't work out, learned some tough lessons, really eager to prove himself with this one. I love the business model, really promising network effects, inherent virality again to the model, but they were getting a little tight on cash. And they were in a place business-wise where I was really confident they'd be able to raise a very successful next round, but money was a little tight. I was willing to dive in and work through their numbers and dig deep with conversations with the founder, existing investors on understanding the model and its potential, and then decided to go ahead and commit to invest in between rounds and help them rally around and bring in money for that next round, which ended up happening a couple months later. And roughly a month after we invested, they had a term sheet for a pre-money valuation that was more than double the price that we just invested at. And it was a win for the company because the founder got to sleep at night knowing that he was going to have enough money to get through to raise a round. And it was a win for our investors because we were able to make the most of that, but in a way that wasn't obnoxious, and the founder was happy, and we have a great relationship. So, that's one example of how those deals come together. And I can talk more about the process in a bit, but, that's a situation where frankly, it was not competitive, but it was timely. And when I say not competitive, there wasn't like a current deck to work through. Like, yeah, you kind of had to get your hands dirty. For another one that we recently did that was a Y Combinator company, that one I knew would be a really competitive deal because the company is building very much in public. The core product's open source software. And so it's the core numbers are right there for anybody to see who just cares enough to find them on the internet. They're just staring at you. And traction is phenomenal. Founder, incredibly bright, incredibly hardworking. And you could see all his commits on GitHub, and you see his amount of hustle and the amount of work he's put into it. You could see the community enthusiasm on places like Reddit, X, GitHub, number of projects started using it, downloads, all just completely up and to right in a really compelling way. The product itself solves for a need that a lot of developers have, particularly ones who are a little picky about how they do their authentication. And so I knew this was one that I was going to have to get in and scrap for. Like, this was not one that I could just wait for it to come to me. So I was really proactive on connecting with the founder, and I did all my work up front. So normally I'll have a conversation with a founder, and after looking at their pitch deck and a little background research, that kind of kicks off the process. In this case, I did the whole process prior to talking to the founder and spent an immense amount of time on it so that after talking to the founder, I could give him a very firm and quick, yeah, look, I'd love to invest. Let's make this happen. And the fact that I was so prepared, the round was wildly oversubscribed. He had tons of demand, but he made it a point to have Seaplane in the round because he's like, hey, look, I love your energy. You're so enthused, and you were just super prepared and asked really thoughtful questions. So, those are different examples of the process has to match the situation to some extent. And I guess to get to like what the process looks like, again, normally it'll kick off with conversation with the founder, start working through a deck. I go off, do some market research, come back, have another conversation with the founder, all very much founder-centric because founders matter so much at this stage. Then I go off and just go through a really deep dive piece of work on my end. So that can look like, I've always been a big checklister. You've heard me talk about that before, but I think checklists are a great way to force you into not cutting corners with your diligence. And even though nobody reads my internal research, I try and structure everything to where if an institutional investor walked in tomorrow and wanted to read it, they'd say, this is exceptional work. Kind of like how Steve Jobs always made it a point to say, look, individual people can't open an iPhone. They can't open a Mac. But if they did, I'd want it to look beautiful on the inside too. And that's kind of how I feel about on my investment research. So I'll go through that, just make sure I'm staying on point with traits that I'm looking for and things that I'm actively trying to avoid. And then I'll dig in, really try and focus a lot on product, market, founder. This has been said, but market kind of dictates how large something can be. Founder dictates what it actually ends up being. I'm very much a product investor. So I like seeing there's a live product. I like digging in and really understanding to a deep level the value that product gives to its customers. Sometimes if it's more consumery, you could say the amount of delight. If it's B2B, just pure, what's the ROI for this? Like how much are investors or customers clamoring for this product? Really try to work through that in a deep level using my AI tools that I've built. I've built some custom GPTs off all my internal research and lots of conversations that dive in and just really help me do better work faster. They're great critics. They're very thorough. They're particularly good for market research. Market research is probably the piece that as a solo GP was the hardest pre-AI because there's so much white space. And sometimes in B2B, you don't even know what you don't know a lot of the time as far as competition. But that has very much leveled the playing field for smaller investors like Seaplane. And then just really diving in, trying to understand the unit economics of the business. The financials at that point, there's not a lot of financials. When I say financials, it's like you might get a QuickBooks printout. You might. Yeah. And that's it. But there's enough there to start playing with the unit economics and kind of put all that together with some reference calls and thinking about the valuation and the context around that, which we could get into. And ultimately trying to make a call. Oh, and I glossed over thinking about portfolio context as well. So not only is this good in isolation, but all the better if it's different from exposures we already have to try and increase the idiosyncrasy of the portfolio. Just get nerdy.
Yeah. No, I was going to ask you about downside protection. So is that the primary way you think about that is just different markets, different projects, different
That's part
industries?
Of it. Yeah, it's a portfolio construction with the caveat that I think the most important thing in venture is upside capture rather than downside capture.
For sure.
I think you manage the downside piece by being thorough, thoughtful, having a process you stick to, not being sloppy or cutting corners. And that may sound really obvious, but there are some small VCs who their game is they just ape into, if they see A16Z is going to do a deal, they just try and get in the deal. They see Sequoia is doing a deal, they just want to be in the deal. Or if one of them led the seed round, they just want to get in the A. And that's the model. I'm trying to do more thoughtful, intentional, original work here. Doesn't mean I'm always going to be right, but that's what I'm trying to do.
One of the things that you would ask like a small cap public markets fund manager is, one, is being small an advantage to you? And two, how big is too big in this marketplace? Like I don't have any reference points at all or any context, Joe. So I'm just curious, is it an advantage? And then do you see that persisting for a very long time to come at Seaplane?
Yeah, there's a non-linearity to fund size in both public markets and private. It can really depend. So at Seaplane, we write 250K checks, which at pre-seed and seed is a good size because it's enough to get a seat at the table. Like founders will take a call with you because it moves the needle on the round. But it's small enough that lead investors who typically may want something like 8 to 10% ownership in the company at a post-money valuation, they can bring you in to help round out the round and make sure the company has enough capital to get after things without stepping on their toes. So it's kind of the friendly neighborhood Spider-Man size check. At some point, a fund would get big enough where you move past the friendly neighborhood Spider-Man and I'm competing with other seed funds on, well, now I want to be the one who leads. And suddenly these people who were your friend before are now your friendly competitor. They're your frenemy. The fund size you have is very much your strategy. That's seen in venture. And the bigger the fund size, typically the more diversified your fund. You may be moving into spray and pray if you get a seed fund that's 9 figures, which to me would be a monstrous fund. But if you look at the multi-stage firms, they've got 9-figure funds and they sling it around joyfully. Then they'll do that because they have the optionality of, well, if they get to the inside track on the seed round, they can lead the A and then the B later. And they've got these huge growth funds and they actually make more money in the later stage ones than the early stage. But I personally prefer a more concentrated fund. That's just always suited me for a litany of reasons, but it allows me to set a higher bar. I can be more thorough and patient on what comes into the fund. It's just stuff that I'm really excited about rather than taking a flyer. And from a venture standpoint in private markets, it leaves me more time to spend talking to my companies and actually engaging and trying to be useful. So, your inflection points of challenge with like pre-seed and seed, again, it's this question of, do you want to lead or not? And how concentrated do you want your fund to be? For fund one, we're not leading and concentrated. So we're in the box of basically, that's a small fund. And when I think about where I want to go in the future, we may lead rounds in the future, but I do want to stay concentrated, which inherently means my funds will not be big. And I'm perfectly happy with that. I don't want to run big funds. And frankly, because I own the firm outright, I don't have this pressure with a lot of mouths to feed to have like a huge asset base, and that's liberating. I think on the public market side, you run into issues with liquidity. So, speaking as someone who's run a few hundred million in Aussie smalls, like, it starts to get complicated once you get to a certain size because you'll look at something and say, I think that's really interesting, but if we wanted to invest, we'd own, 5% of it, then everybody knows we own it. And public guys are sharks, brokers are sharks, and we don't want them knowing we have that kind of size. If we want to get out, it'll be very difficult. And there were times that we had to pass on deals because of liquidity constraints. And probably the best/worst example of that, this was pre-Lake House, was I think I'd been in Australia for like 2 or 3 months. And I was at this pitch event at the Four Seasons in Sydney. And Sam from Pro Medicus was presenting. And I was like, this is great. This is so good. Oh my God, I love this. And I was like, maybe we should run with this at the Fool and recommend it. And then I looked at the float and it was tiny. And I'm like, we can't recommend this. Like, we'll move the stock. In hindsight, should have done it, even though we would have moved the stock, I think everyone would have been happy. But yeah, those are just different kind of constraints you're working with. But I think for me, just with the strategy I have, it's inherently boutique and I'd like to keep it that way.
Well, people can definitely find out more about you and Seaplane on the website. I put a link in the show notes, but you also have a great podcast, which you stood up not too long ago. And I got to admit, I was thinking about this morning. You might like this. I reckon the 2 podcasts that I've listened to the most in 2025 are yours and David Gardner's Rule Breaker Investing. So I don't know what that says. Says. Because I'm not like in the VC space, but I just find everything that you talk about and everything that you do super fascinating. And to hear you apply your lens in a very like pointed way is really compelling listening for anyone that's interested in unit economics, SaaS businesses, venture conversations in general, and just maybe where the world is going. It's really compelling. Like even this morning, I was listening to a podcast that you did with Techstars, which I think is one of the more recent ones. And like obviously not my world, but still really, really fascinating stuff. So how have you found the podcast?
I love it. I've always loved doing podcasts. I just love talking about investing with people and going back in time. I was on Motley Fool Money forever ago and loved doing that show. It was great. And podcast just feels like a natural forum for me to get out and talk to people. And one of the best things about having your own show is you just get to invite people that you enjoy talking to and ask them a bunch of nerdy questions. And I just try and do the show through the lens of, is this something that a smart person, not necessarily a VC, but like a smart, curious person who's interested about investing in startups would like to listen to the show. And I have people on who they're firm founders. Like I try to keep it to decision makers and people who've put real skin in the game as far as starting their own firms and have unique points of view, which I don't always agree with. Like I'll have people on the show who, they'll say something and sometimes I'll push back, but like, I don't always agree, but that's okay. And that's part of what makes it fun and interesting. Like I was at a dinner recently and I had, 3 people across from me, 2 on the side, and everybody had completely different strategy. And it made for a really dynamic dinner conversation. And nobody got angry or, splashed any water in anyone else's face. But it's good. And I love that kind of thing. I think talking to really smart people makes you sharper. I've learned things from guests we've had on the show and gotten a lot out of. And I'm glad you're enjoying it. I'm having a lot of fun with it.
Yeah, it is great, mate. And I love the questions and just how concise everything is. So one of the things, Joe, that I contend with is like with private and public and VC and all this type of stuff is that there seems to be so many nuances with private markets in general, but then VC, again, big picture question, what's the hardest part about deploying capital, about your role in VC versus, say, public markets?
There are a few big differences. Some are harder than others. One is that you're working with less information and you need to make decisions faster. So let's say you're an ASX small cap manager. You've got a pretty static universe. I'd say after 3 or 4 years of working with Donnie on the small cap fund, we knew pretty much every small company on the ASX that was, worth its salt, or not even any salt, but we just knew them. And it was exciting when something new listed because we'd already kicked all these other tires. In startups, it is a perpetual machine of new companies that are coming. And the opportunity to invest isn't just this perpetual right. They're raising around. You got a couple weeks to figure out whether or not you're in or not. And if you want in, you may not necessarily get an allocation. So if they are really oversubscribed and they've got tons of demand, they are going to give allocations to the investors who can add them the most value. And that value comes through, maybe it's a lot of capital, maybe it's their network, maybe it's expertise, relationships. There are a lot of different permutations for that. And so I think if you're just coming in from this place of, well, I just pick the stocks I want to pick and I've followed them for years, that's just not how things work in startups. You have to be on the hop all the time, ready to dive in and do work. And that's fun. That's dynamic, but it is a really big difference. And then on the, access piece, like I said, you don't always get into the deals you want. And I'd say I've gotten much better at getting into deals just as Seaplane's reputation has grown. And frankly, I've gotten better at winning allocations,
Cool. I know we're coming towards the end of the show, but you did touch on a point before, which I just think maybe is worth talking about. Like there is a lot of disruptive force with AI and these types of things, and just people thinking about like lots of capital just flowing into various markets, not just venture. You mentioned before that you think it's a good time to deploy capital. And I just wanted to ask maybe this is where we can end today's discussion is, are you as optimistic, more optimistic about what years to come might be for you and your ability to deploy capital?
Yeah, I think if anything, what I've seen over the last year or so is pretty affirming around that. I think there's clear demand from later stage investors and from public markets for disruptive high growth companies. And it's nice to see that's back. I think 2021, there was too much. Late 2022 and 23, 24, there was not enough. And while things might seem a little frothy from a public standpoint, and there are in some cases, I think we're closer to some kind of normal baseline on that front, and at least in between the highs and lows where we've been over the last 5 years. But yeah, I mean, structurally, I just think pre-seed and seed are good places to be. You're competing in a way that is hard to index against. It's probably one of the last places where you'll see indexation because it's really hard to apply some kind of index passive framework to pre-seed and seed investing where, you might have a couple $100,000 in revenue, not a lot to work with, and while I've got like custom trained AIs, I'll tell you, they're not great at pre-seed. They're great at figuring out if something's a fit for the strategy and they can understand the business model well and the market, but they don't have awesome judgment at pre-seed because there's so little information to work with that they like everything. They're like, oh, I could totally see this working. And I'm like, sorry to tell you, but most of these are very much not going to work. And so if you want to stay in a place where there's a big asymmetry of returns, you're not going to get steamrolled by passive, and there's still always going to be some level of craftsmanship, I think it's a great place to just hang out and do work, or at least for the next couple decades, which is what I'm planning to do.
Yeah, I love it. You're right at the frontier of where innovation happens and where creativity kind of starts to, that meet the road. I feel like that's just a fountain that just keeps on giving, right? Like every new innovation brings more innovation. And that's super exciting for you and all the investors in Seaplane and your ability to deploy capital in these wonderful businesses, mate. So I know it's a bit balmy over where you are and it's a bit chilly where I am, but you definitely warmed me up, and it's really good to chat with you, Joe. Always really appreciate your generosity and sharing your insights with us here on Rask. So once again, mate, all the best with Seaplane, but also keep doing the podcast. Investing in startups, it's really cool, really compelling stuff. So thanks, mate.
Well, I appreciate that, Owen. I think this is the 4th time I've been on your show or a show of yours over the years. So I really appreciate that. These are super fun. I'm happy to see you crushing it. You've been on a journey through that, and it's fun to see you doing so well. So I appreciate it, and thanks for having me.
Thanks, man.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups does not have sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai, and thanks for listening.
Joe Magyer is the founder and managing partner of Seaplane Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Seaplane Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.